Hi, welcome to this week's online module. For this week's online module, we're going to be learning about modern portfolio theory. Modern portfolio theory is known by a number of names. Most commonly used ones are simple mean variance optimization models or mean variance optimization models, or they're even sometimes referred to as the Markowitz mean variance optimization theory. We're going to go over some of the basic concepts for modern portfolio theory and how this technique is used to help investors get the maximum returns at the minimum risks and create a portfolio which is efficient and optimal. So let's go over some introduction for modern portfolio theory. Modern portfolio theory is a normative theory. Any theory which is considered a normative theory is one that describes a standard or norm of behavior that investors should pursue in constructing a portfolio rather than a prediction concerning actual behavior. So this basically refers to something that you should do. For example, we should be drinking 8 glasses of water a day because that's considered to be healthy. The same way, modern portfolio theory gives you certain standards or norms that you should conduct so that you can maximize the returns that you derive from your investments. It would not be an overstatement to say that modern portfolio theory has technically revolutionized the world of investment management because it allows managers to quantify the investment risk and the expected return of a portfolio. So not only does it help the investors by maximizing the return that they get at minimum risk, but also it helps the financial professionals and investors evaluate how they can basically set up a criteria to select a portfolio manager which is better than the other portfolio managers. So this theory shows that it is possible to combine risky assets and produce a portfolio whose expected returns have still considerable lower risk compared to other portfolios. So in other words, it is possible to construct a portfolio of assets whose risk is smaller than some of all of its individual parts. If you look at individual assets in that portfolio, they might have higher risk profiles, but combining them together creates a portfolio which in summary and in combination with all the other assets create lower risk and gives you higher returns for that low level of risk. So practitioners have been using this to help understand which portfolios are better than other portfolios, and it also helps them in the selection of assets for the portfolios. So before we actually start off with the details of modern portfolio theory, we need to first understand some of the basic concepts and assumptions that lead us to modern portfolio theory. And one of them is the economics concept of utility. So in economics, the theory of choice is a theory that uses the concept of utility function to describe how people make decisions when they are faced with a set of choices. So for example, every day we decide what should we have for lunch, and then we have 2 or 3 options and we make a selection based on our preferences from the options that we have. So utility functions and utility theory is just an effort to understand what preferences do investors have and how do they select or how do they make a choice from the alternatives that are given to them. So the utility function that is generally used in utility theory is it's a mathematical expression that can describe the preferences of that individual or that investor over a perceived risk and return combination. So for example, on the right hand side here, you see three different indifference curves. All three of these are indifference curves, but they are also giving statements about the utility of three different investors. On the y-axis here, you have the expected return, and on the x-axis, you have risk. So generally in finance, when risk increases, so as I move along this horizontal axis, the investor is also going to ask for more return so that they can compensate for that additional risk, which is why you see that all of these indifference curves are basically upward sloping, because as risk increases, expected return is assumed to increase as well. However, the different levels of these indifference curves is set by the preferences of that individual investor. So looking at this particular example for indifference curves, we can assume that each of these curves belong to three different investors. The first investor is investor number 1, which has this black indifference curve, and the last investor is investor number 3, who has this lighter gray indifference curve. The difference between each of these curves is the preferences of that particular investor. So although all three of the curves are upward sloping, which means all three of them are rational investors, they're going to demand a higher return for higher risk, but the level of return that they demand at each level of risk is going to be different. So for example, if I am a person who does not like risk too much, I will probably have this lighter curve, which is U3, as my indifference curve, when compared to another person, let's say Adam, who does not mind so much risk. In fact, risk gives him the thrill, and he enjoys taking risks. So for example, people who love to gamble or people who are adventure lovers might be more risk loving than the rest of the population. So this lower black indifference curve would be a curve associated for such people. Now, utility theory and utility functions are in part used in portfolio theory too, because in portfolio theory as well, individuals are faced with a set of choices. So different portfolios have different levels of expected return and risk, and typically the higher the expected return, the larger the risk. So individuals are faced with the decision of choosing a portfolio from the set of possible risk-return combinations that are offered to them. So depending on how much they like or dislike risk, they're going to make a selection from the given choice of portfolios that are in front of them. So that's why utility theory and this concept from economics fits perfectly into our modern portfolio theory and building a foundation for that. Next, we're going to talk about the set of efficient portfolios and what do we mean by when we say optimal portfolio. So portfolios that provide the largest possible expected return for any given level of risk are generally called efficient portfolios. So for example, if you have 3 different portfolios and all 3 of them have the same level of risk, but portfolio 3 has the highest returns out of the 3, then portfolio 3 can be labeled as the efficient portfolio because it achieves this higher return for the same amount of risk. So in order to construct an efficient portfolio, it's necessary to make some assumptions about how investors behave when making investment decisions. Usually a reasonable assumption is that investors are risk averse, which means that they do not like risk. So a risk averse investor is an investor when you give them 2 options, of investments with the same expected return, they will always select the one which has the lower risk. Now, this might seem like an obvious choice, but there could be situations where people would prefer the higher risk situation, which is why we have to clarify and define this assumption so that it's clear from the beginning. In selecting portfolios, investors usually seek to maximize their expected portfolio return, and that also is dependent on how much tolerance they have for risk. So if a person is more risk averse than me, then they would obviously select a portfolio which is going to have a lower risk profile than the other portfolios, and they might be willing to settle for a lower total return as well. Given a choice from the different sets of efficient portfolios, the optimal portfolio is the one that is the most preferred by the investor. So you could have multiple efficient portfolios in front of you, but the one that matches your risk preference would be the most optimal portfolio for you as an investor. The third basic concept that we need to address before we move on to modern portfolio theory and the details of the methodology is the difference between risky assets and risk-free assets. A risky asset is one that the return for which can be realized in the future, but it's uncertain. So, for example, if an investor purchases the stock for Netflix today with the intention of holding it for some finite amount of time, does not know what the returns will be like at the end of the holding period. So if their holding period is December 2020, we don't exactly know where the stock price of Netflix will be. The return will depend on the price of Netflix at the time of the sale, and as well as on the dividends that the company pays during that holding period. Generally, most assets are risky because they do have some level of risk associated with them, but risk-free assets can be considered as the ones that are backed up by the government for most cases, because they have a guarantee sort of from the government to pay off the returns on that risk-free asset. So in general, short-term obligations of the U.S. government, such as bonds that expire in less than 1 year and they have been issued by the U.S. government, can be considered risk-free assets because the government will most probably a high chance of giving you the return that was promised on that particular class of assets. All the other assets, such as equities, stocks, bonds issued by corporations, they are considered risky assets. The level of risk is going to obviously depend from asset to asset, but they all fall under the risky assets category. After understanding the basic concepts that lead us to modern portfolio theory, we're now ready to define the actual and the expected return for any risky asset and for our portfolio, which consists of those risky assets. So first, we're going to define a single period portfolio return, which means that we're assuming that we have a portfolio named P, and the return for that portfolio for any single period of time, that period of time could depend on how long of a time horizon you're looking at. If you want to look at really short-term returns, this could be daily returns. If you want to look at medium term, it could be 1 year or 3-year returns. Or if you're looking at it long term, it could be a 5-year portfolio return or a 10-year portfolio return. But it's still one single period, one single chunk of time that we're looking at. So we're defining the return of our single period portfolio as RP. And assuming that we have capital G number of assets in the portfolio, the total portfolio return is going to be a weighted sum of the individual asset returns in our portfolio. This G could be any number from 2, having just 2 assets in your portfolio, to 10, 15, 20, as many as you want. And the weight W is defined as W of G. This is specific to each asset in our portfolio. So asset 1 will have a weight of W1, asset 2 will have a weight of W2, and so on till finally we reach asset capital G, which is the weight for that asset would be W capital G. The individual returns for each asset are given by RG. And so asset 1 has a return of R1, asset 2 has a return of R2, and finally asset capital G has returns of R capital G. So the same above equation, equation 1, can also be written in a shorthand form like what you see in the bottom of the slide. This is the same as equation 1, except that we're using these mathematical symbols to help us write down the equation in a concise manner. This is the sigma symbol, which stands for summation. It just means that you're summing WG multiplied by RG over all possible values of little g, where little g can take values starting from 1, 2, 3, going all the way till capital G. So if capital G was 3, this would just be little g1 going from 1 all the way till 3, and then you're just summing up the product of the weights along with their returns. So this shorthand notation, let's call this equation 2. This equation 2 states that return on a portfolio RP of capital G assets is equal to the sum over all individual assets weights in the portfolio multiplied by its respective return. So sometimes we also call this RP as the holding period return, or even the ex post return. So let's take an example of a portfolio consisting of 3 assets. I'm going to switch my screen to an Excel screen so that we can look at this simple example in Excel. So for example, consider this portfolio that you see on your screens right now. It consists of 3 assets, assets 1, 2, and 3. And the market value at the beginning of the holding period for each of these assets is given in column B, and the rate of return for the holding period is given in column C. The portfolio's total market value at the beginning of the holding period is then equal to the sum of these individual market values, which is equal to $25 million. I'll just put it highlighted so that we can remember that this is the total portfolio market value at the beginning of the holding period. So now we can calculate the weights for each of the assets. I'm going to label them W1, W2, and W3. The weight for asset 1 can be calculated by dividing the market value for asset 1 by the total portfolio market value. So this fraction is going to give you the weight for asset 1 in your portfolio. The same way the weight for asset 2 would be the market value for asset 2 divided by the total portfolio market value. And finally for asset 3, we follow the same process. Oops, sorry, I made a mistake. So 11 divided by 25. And let's convert these into percentages. And just to make sure, the sum of these percentages has to equal 100%. And there it is. So the individual weights of the assets are given by these numbers here, and they're calculated using the same methodology that I just used. So now using these weights, we can actually calculate what the total return of our portfolio RP is going to be. Using the formula that we just discussed over the PowerPoint slides, it's a combination of the weights along with the rate of individual return for each asset. So essentially, what the total return of the portfolio is a sum product of the array of weights along with the holding period returns. And this is going to give you the total rate of return for the full portfolio consisting of these three assets. I hope this example can help clarify the formula, the two equations that we used in the slideshow just earlier. Okay, so now that we've defined how we are measuring and what formula we are using to calculate our portfolio's return RP, we are going to move on to define the next term that we will be using a lot throughout this concept and throughout this lecture series is the concept of expected return for a portfolio of risky assets. In the previous two equations, we showed how to calculate the actual return of a portfolio over some specific period of time. In portfolio managers, the investors would also like to know the expected or the anticipated return from the portfolio of risky assets. The expected portfolio return is the weighted average of the expected return of each of the assets as a percentage of the market value of the asset to the total market value of the portfolio. So we're using the formula, which is similar to what we saw in equation 1. The only difference here is that you will see this E symbol in front of all the returns. The E symbol is there because this refers to expectations. These are expected returns, so we're talking about a future time period and we haven't actually observed those returns yet. This is what we are anticipating, or this is what we are expecting. The E of RP is generally called the expected rate of return of the portfolio, but sometimes it's also called the ex ante, or the expected portfolio return for the specific period of time. So the way we calculate the expected return for the portfolio is using individual expected returns for each asset. And if you look at each individual expected returns for the asset, the question would be, how do you get the value for this expected return for each individual asset if we're talking about the future and if we still don't know or haven't observed what those values would look like. So in order to look at that carefully, we're going to use another equation, which is the expected value formula, but this time this is the expected value for the return on asset I. And that's just a simple sum product of the probability for each individual return value. So we're talking about asset RI. Let's say that you invested in the stock of company XYZ, and RI refers to XYZ's return. So the probability for that return, taking any value between R1 to Rn, and the assigned respective probabilities, will give you the expected value for the expected return on the risky asset I. So first, a probability distribution of possible returns has to be specified. That's where these P1, P2 all the way till Pn numbers will come from. Given the probability distribution, the expected value of the random variable is simply just the weighted average of the possible outcomes, where the weight is the probability associated with those outcomes, which is why this equation looks very similar to what we have in equation 3 and also what we had in equation 1. So having specified a probability distribution for the possible rates of return, the expected value of the rate of return for each asset is calculated. And finally, rather than using the term expected value of the return of an asset, we will just simply use the term expected return. And that's what we mean by this E of Ri in this equation. So let's take a look at a simple example in Excel to help us clarify this concept even more. So generally, when we have to determine expected returns, we have to specify a probability distribution that we think would be appropriate for whatever random variable that we're trying to study. And we've gone over this in the beginning of the class, where we went over a certain number of options for distributions that we can select for this purpose. One of them, and the most commonly used one, is a normal distribution. You could also use a different distribution, and we're going to cover an example which is not a normal distribution, and it's one of the ways of assigning a probability distribution to the stocks that you have included in your portfolio. Generally, long-term historic returns can help us determine a good probability distribution for the particular asset that we are considering. However, for the purpose of this illustration, let's assume that an investor is considering investing in a stock for XYZ. And the probability distribution that we are assigning to these expected returns is given in this table here. So N represents the possible options that the return can take, the values that the return can take. Now, so N number 1 means that the return for stock XYZ is 12%, whereas N number 5 means that you don't have a positive return. In fact, you make a loss of -4%. And the probabilities associated with each of these returns. So if we're using equation number 3 to help us get the expected returns for the stock of XYZ, we are simply going to use equation 3, and in Excel that means we're going to use the sum product of the rates of returns with their respective probabilities, and that should give you the expected return for this security stock of XYZ, which is equal to 7%. This is the mean of the probability distribution for the rate of return on stock XYZ.